Have you ever wondered how much you could make by investing in VOO in 10, 20, or 30 years? Join us as we dive into the world of investing, specifically the Vanguard S&P 500 ETF, or VOO. This is a known exchange-traded fund that tracks the performance of the S&P 500 index, a well-accepted U.S. stock market performance benchmark. VOO is marked by the market's leading companies and is famed for delivering a substantial compound annual return of 10.29%. However, like any investment, it carries risks. Spend this brief time exploring VOO, its functioning, and its potential rewards and risks. We aim to equip you with a clearer understanding of this investment tool. Let's dig into the intricacies of this promising investment vehicle together. To understand the potential returns from VOO, we first need to understand what it is. VOO, also known as the Vanguard S&P 500 ETF, embodies a particular branch of investment vehicles broadly classified as an exchange-traded fund, or more commonly, an ETF. But to truly delve into the crux of the matter, we need to ask ourselves, what exactly is an ETF? Picture a diverse and well-curated basket filled with a variety of investments. This could encompass stocks, bonds, commodities, or other types of assets. The concept of this basket is crucial to understanding the essence of an ETF. This basket, with its varied contents, is then divided into shares which are made available for sale on the stock market, very much like the stocks of individual companies. Hence, an ETF can be perceived as a basket filled with diverse investments, and as an investor, you have the opportunity to buy a piece of this basket. But what exactly makes this idea resonate with investors worldwide? The answer is unequivocally diversification. Investing in an ETF allows you to spread your investments across an extensive range of assets. This act of diversification significantly reduces the inherent risk associated with investing all your capital in one singular asset or investment. It serves as a strategic method to gain broad exposure to a specific market or sector, eliminating the need to purchase each individual security within that market or sector. So, what sets VOO apart from other ETFs? The VOO is the brainchild of the Vanguard Group, one of the world's most established and prominent investment management companies. This ETF is unique due to its focus on tracking the S&P 500 index, a market capitalization-weighted index that includes the 500 largest U.S. publicly traded companies. In simpler terms, investing in VOO is akin to investing in the 500 largest and most influential firms in the U.S. economy. Furthermore, VOO is highly regarded for its low expense ratio. The low expense ratio signifies reduced costs for investors to own the ETF. These lower costs can potentially lead to increased returns over a longer period, making VOO attractive for investors who are mindful of the fees and expenses associated with their investments. Now that we've unraveled the concept of VOO, we can proceed to explore its profitability. This ETF boasts a steady track record, with a compound annual return of 10.29%. But what does this figure imply for potential returns? How profitable could an investment in VOO turn out to be in a span of 10, 20, or even 30 years? Now that we know what VOO is, let's move on to how it can be a profitable investment. So, how profitable is VOO, and how does it achieve these returns? The profitability of Vanguard S&P 500 ETF, otherwise recognized as VOO, is fundamentally linked to the performance of the S&P 500 index. This index is an aggregate of a colossal 500 of the largest U.S. companies, a representation of a wide cross-section of the American economy. It's akin to owning a minuscule share of all the major players in the corporate arena. VOO mirrors this index, so its profitability resonates with the long-term profitability of the S&P 500. Now let's delve a little deeper into the world of S&P 500's profitability. The S&P 500 has proven to be a consistently profitable investment over extensive periods, historically providing investors with an attractive compound annual return. What does this mean? It implies that over time, the value of an investment in the S&P 500, and in turn VOO, expands by a certain percentage each year. Let's not overlook that VOO also offers a dividend yield, which stands at 1.34%. It's an added bonus for investors that further contributes to the overall returns, and the figure that truly stands out for VOO, a compound annual return rate of 10.29%. Astonishing, isn't it? On average, over the long term, that's over 10% each year. This, ladies and gentlemen, is the compelling power of compounding. The returns of your investment begin to generate returns of their own. But remember, past performance doesn't promise future returns. The market is a complex entity, influenced by an array of factors, some predictable, others entirely unforeseeable. However, the diverse portfolio of the S&P 500 and thus VOO aids in buffering against the erratic nature of individual stocks. Despite this variability, the long-term trend of the S&P 500 has remained upward, and VOO paves a way for investors to leverage this growth potential. It's a strategy that entails surfing the wave of the American economy, wagering on the combined triumph of its largest. Let's look at how much you could potentially make from investing in VOO. Having explored the potential returns from VOO, let's now turn our attention to another compelling aspect of this ETF: its dividend yield. Currently, VOO has a dividend yield of approximately 1.34%. It's crucial to understand what this means for you as an investor. The dividend yield is a key financial metric, a ratio that highlights the annual dividends a company disperses relative to its share price. Within the framework of VOO, this dividend yield is deduced by performing a division operation. The annual dividends distributed are divided by the ETF's price. The outcome, illustrated as a percentage, is known as the dividend yield. It is a representation of the investor's yield on investment, excluding factors like price appreciation or depreciation. Dividends aren't just a simple source of income. In fact, they serve as a formidable tool for magnifying your total returns when they are reinvested. What does reinvesting dividends entail? It involves utilizing the dividend funds to purchase more ETF shares, thus incrementally increasing your investment and potentially your future dividends. This tactic is frequently referred to as compounding, and it has the potential to significantly enhance your total returns over a long-term span. To better visualize this concept, let's hypothesize a few scenarios. Imagine that you've invested $10,000 in VOO and you decide to reinvest the dividends. Following 10 years, presuming a constant dividend yield of 1.34%, your investment could potentially expand to approximately $11,400. If the dividends are continually reinvested over a duration of 20 years, your investment might burgeon to around $13,000. And what about after 30 years? Well, you might be looking at an investment value exceeding $16,000. These hypothetical situations underscore the potential benefits of reinvesting dividends. However, as is the case with any investment strategy, there are inherent risks. The actual returns could either surpass or fall short of the expected figures depending on multiple variables, including fluctuations in the dividend yield and the ever-changing market conditions. But one fact remains indisputable: reinvesting dividends has the ability to significantly boost your overall returns over the long term. Let's visualize what it might look like if you invested in VOO for 10, 20, or 30 years. What would be the potential returns? In order to comprehend this, we'll dive deep into the fascinating of compound annual return. This term illustrates a vivid image of how your investment escalates yearly. This growth is due to the fundamental concept of compound interest. Focusing on our investment of choice, VOO, or the Vanguard SNP500 ETF, it has shown a historical compound annual return of approximately 10.29%. Now, let's construct a graphical representation of this prospective return with a hypothetical investing scenario. Visualize this. You invest $10,000 in VOO and let it remain untouched for 10 years. Concurrently, consider a compound annual return of 10.29%. The projection suggests that your investment could potentially surge to a sum of around $26,000. That's a portrayal of your initial investment more than doubling in value. However, what if you allowed your investment in VOO to sit idle for 20 years? With the miracle of compounding, the image can become quite electrifying. In this scenario, your $10,000 could swell up to approximately $71,619. Let's extend our mental projection to 30 years, a standard investment horizon for retirement planning. After this period of 30 years, your $10,000 could ideally grow to an astonishing $192,117. It's important to note that these projections are based on the historical performance of VOO and the S&P 500. It's fundamental to understand that past performances, while useful, do not necessarily predict future results. Your real return could be significantly higher or lower depending on a multitude of factors, including market economic trends and changes in the companies that comprise the S&P 500. Investments, as with any financial endeavor, come with their fair share of risks. It's crucial to realize that while the prospect of high returns is appealing, investments can also decrease in value. Always remember the proverb, "Don't put all your eggs in one basket." Diversification is a key strategy in managing your investment risk. To mitigate risk, it is advisable to spread your investments across a range of asset classes and sectors. This way, if one investment performs poorly, others in your portfolio may do well and balance out the losses. However, every investment landscape, including VOO, also has risks lurking. It's vital to remember that while the visual of high returns is appealing, investments can also dwindle in value. In line with the age-old wisdom, don't put all your eggs in one basket. Diversification is key in managing your investment risk. So, why might an investor choose to put their money in VOO? This question triggers an exploration into the world of smart investment choices. A world where an individual investor's financial gains are a priority, and where benefits are multifold. The first of these benefits is diversification. VOO, formerly known as the Vanguard SNP 500 ETF, is a fund that has been set up with the intent of tracking the performance of the S&P 500 index. The S&P 500 index is a measure of the stock performance of 500 large companies listed on the US stock exchanges. So, when one chooses to invest in VOO, what they're effectively doing is buying a minuscule part of the 500 largest publicly traded companies in the United States. This concept in itself is fascinating when you consider the broader picture. Investing in the VOO means spreading your money across a wide spectrum of sectors and industries. This tactic is a proven method to mitigate potential risks that come with putting all your eggs in one basket. The second benefit that makes VOO a favored choice among investors is its incredibly low fees. The expense ratio for VOO at a mere 0.03%. To give you perspective, this is one of the lowest you'll find for any exchange-traded fund, ETF, available in the market. Now you might wonder what this implies for you as an investor. Well, the lower the fees, the more of your money stays invested. And if more of your money stays invested, it has a higher potential to grow over time. However, as we marvel at this remarkable growth, it's crucial to remember that past performance does not guarantee future results. The stock market is a roller coaster. It has its highs and lows. While VOO has a commendable history of strong performance, it also comes with a standard deviation of over 15%. This implies that the returns can deviate significantly from year to year, and investing in VOO does involve a certain degree of risk. Despite the risk factor, for individuals comfortable with this level of uncertainty and who have a long-term vision for their investments, VOO can be an extremely attractive option. It provides a straightforward, cost-effective method to gain exposure to the vast landscape of the US stock market. And as we have seen, it has the potential to deliver returns over an extended period. In conclusion, VOO can be a profitable investment for those willing to take on the associated risks. In this video, we've discussed what VOO is, how it works, and the potential returns. Welcome to our detailed analysis of VOO, otherwise known as the Vanguard S&P 500 ETF, a popular player in the realm of exchange-traded funds. To begin with, we discussed the nuts and bolts of VOO, breaking it down in an approachable manner so that even first-time investors can grasp. We dove deep into its intricate structure, expertly set up to emulate the performance of the globally recognized benchmark for US stock market performance, the S&P 500 index. The S&P 500 index in itself is a fascinating arrangement of the 500 largest, most influential companies listed on American exchanges. It provides a comprehensive picture of the US equity market. VOO, mirroring this index, offers its holders incredibly broad exposure to this market. For those seeking direct involvement with the US equities, VOO is an excellent tool. Furthermore, we probed the profits associated with VOO, realizing that its performance is closely tied to that of the S&P 500. This is an essential point to remember. The compound annual return of VOO has been observed to hover around 10.29%. Now, this may seem like just another number, but it's a reflection of the S&P 500's performance over the years, and that is a testament to its reliability. We next turned our attention to the potential future of VOO. We speculated and projected what an investment in VOO could look like in the next decade, 2 decades, and even 3 decades, assuming the same compound annual return. Through our examination, we learned that regardless of short-term fluctuations and market instabilities, VOO has maintained a generally upward trend in the long term. This is a potential beacon of promise for potential investors, indicating the possibility of consistent growth. And why should one consider investing in VOO? We delved into this as well. Apart from offering a wide exposure to the US equity market, VOO stands out for its potential for long-term growth. Add to that, its low expense ratio makes it a viable choice for investors who are careful about the costs of their investments. But remember, every investment carries its own set of risks. Therefore, thorough research and an understanding of your financial goals are of utmost importance before you decide to take the plunge. Remember, every investment comes with risks, so always do your research and consider your financial goals before investing. Thank you for watching and happy investing. Before we wrap up this video, we'd love to hear from you. If you found this video insightful and you'd like to see more content like this, please hit the like button, subscribe to our channel, and leave us a comment about your thoughts on VOO or any other investment options you'd like us to cover in the future. Your feedback is valuable to us, and it helps us create better content tailored to your needs. Plus, subscribing will ensure you never miss out on our expert investment advice and analysis. Remember, the world of investment is vast and full of opportunities, and we're here to help you navigate it. So join our community today and let's embark on this financial journey together. Thank you for watching, and here's to your financial success.